Hey guys, Barry Page with Legacy Money, your resource for generational wealth building and infinite banking strategies. Our passion is helping you and your family to live more, give more, and leave more. Be sure to subscribe to our YouTube channel, Legacy Money, where we'll have new content weekly. Thank you for joining us.
Hey guys, it's Barry. So today we're going to answer a question that comes up often, and that is, how should I pay for this? And it really doesn't matter what it is, any major purchase. It could be a car, it could be an air conditioner that went out just like we just had this week. It could be maybe real estate or an investment. Whatever this major purchase may be, we're going to talk about the ways you can pay for it. So the first thing to remember is you finance everything that you buy. You either pay interest to someone else for the use of their money, or you give up the ability to earn interest on your money. So let's get into it, and we'll talk about the best way to pay or finance for your major purchases.
Okay, here we are. So for this part of the exercise, we are going to use my good buddy Don Blanton software from Money Tracks Incorporated. It's the Circle of Wealth. So as I said earlier, you finance everything you buy. You either pay interest or you give up the ability to earn interest. So some transfers are avoidable, others you can only minimize. What you need to understand is that every dollar not saved is consumed by transfers and lifestyle. So let's take a look. Now there's many ways we transfer away our wealth, and we're going to specifically today talk about major purchases. And again, this could be credit cards, financing a car, trading cards, whatever it might be, even a mortgage. We're going to try to keep it real simple, and we're just going to talk about some of these major purchases here. So let's get into it. So before you have any capital outlay, you must consider the cost and the opportunity cost. So it's not just what you pay for it, it's how you pay for it. So let's take a look at that. And again, this goes back to the question, how would you like to pay for it? So would you rather pay cash? Would you rather finance through a financial institution, a bank? Or would you rather pay for it from your own capital pool? Let's take a look at a couple of examples. So in this example, we're compounding interest. And let's say we had saved up, or we had an initial balance of $30,000, and we were looking over five years at 5%. So at the end of that time, we would have earned $8,501 in interest, and we would have $38,501 in that account. Simple enough. So what if we amortized that same example? So again, we've got $30,000, but now that's debt. We owe $30,000. So we're going to pay it back at 5%, the same as we were earning. Now the payment would be $566 a month in this situation, and the total cost would be $38,501 to give us a zero balance. Now, a lot of this goes into the interest again and the lost opportunity cost. So in this example, $39.68 is the interest that was paid, but we also have the interest at interest. In other words, what the money could have earned had it not been going to pay for that over time, the lost opportunity cost. Okay, so the total cost is $38,501. So the numbers are the same, whether or not you're earning money, compounding interest, or you're amortizing, paying interest. That's a head scratcher for some people, so just let it sink in a little bit and understand that that's the way that banks make money, and that's how you also can make money. So how do you buy, borrow, or pay for your major capital purchases? Let's take a look. The debtor works to spend. He has no savings, no work, earns no interest, pays interest. Saver saves money to avoid paying interest. They save, they earn interest, and then they have to pay cash, so they drain their tank, their ability to earn interest after, because they just spent all the cash. They've interrupted the compounding curve. The wealth creator uses other people's money to maximize efficiency. They save money, they compound interest, and they collateralize their purchases. That's the big difference. We all know the problem with consumer debt. There's also problems with paying cash. Pay cash, you need to first save cash, right? So imagine this tank here is filling up with cash. Now, when you do it this way, there's tax leakage. When you finally get your tank full, now what do? You have to drain the tank to make your major purchase. So you're interrupting the compound interest curve. You're killing the compounding of your money now because you've spent it to pay cash for the purchase. So let's take a look at that, and we'll use a similar example as we had earlier, just to kind of keep the numbers equal. And we're going to say that a person is contributing $6,000 a year, so $500 a month. We're going to look at over a 30-year time frame. So again, maybe this is vehicles. It really doesn't matter. Just grasp the concept. And what it's saying here is we're going to repay in 5-year increments, just like earlier, okay? So refilling the tank. Now, what I want you to notice here is that the money, had it been able to grow fully compounding over the 30 years, it would be $424,565. That's $6,000 a year, right? Or $500 a month, however you want to look at it. All right, but when you delay, okay, the purchases, in other words, you have to drain the tank every time by paying cash, right, and refill it. There's a cost for that, right? So there's the $40,811 where you just drain the tank after the 5 years, right? So the long-term difference, just for financing vehicles or making a $6,000 a year contribution, okay, or maybe a $30,000 car over 5 years, whatever, however you want to look at it, whatever the purchase may be. Obviously, cars cost more and less, but you get the point. The point is there's a long-term difference just in that scenario of $383,000 for financing your cars using or paying cash for your vehicles. So what if you can make the purchase without emptying the tank? And the question we get is, well, if I don't use my money, whose money do I use? And that's a great question, because what we do is we collateralize our purchases. And that's what infinite banking is all about, using your own capital to finance your purchases. So we collateralize a loan using our life insurance policies. We don't take the money out of the policy. We use the policy as collateral to make our loan. So I hope you gained something from this exercise. Should you pay cash, or should you finance? Or should you finance using your own bank? So that's it for today. I'll talk to you again real soon.